Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome back to Surgeon Syndicate. This is your host, Dr. Michael McManus, and we are here with Amit Gaglani. Amit is a physical therapist, a business owner, a business grower, and a real estate investor, and currently also has a company that manages investor relations for other syndicators. So let's just jump back into that conversation with Amit. Okay. So what investors are looking for today? How much do you hear concerns about what's going on in the news cycle? So, I mean, if you look at the newspaper, you turn on the radio and it's like, oh, there's $80 billion of multifamily loans, I think has been the big headline lately, that are coming due in the next 18 months. It's kind of a prediction that, well, these things are going to it's kind of a doom and gloom thing.
Yeah. So the interactions that we have with our investors, you can tell that they're reading something, but they don't they don't say, oh, I read this and therefore I'm not going to be doing this. But you can tell what they have fear of something, right? And you're trying to pull out like what you're making decisions based on something. What are you making your decisions on, right? And then it takes time for us to pull that information out. And it could be, like you said, a news article that sometimes isn't exactly even correct about what's exactly going on. And I'll give you an example. Rents are starting to go down. So we have represented a company that has properties that are in the Midwest. Now, what's happening in the Midwest is rents are actually going up because there's people leaving the coast and actually going in the middle of the country. So they're getting a surge and their rents are actually going up. But when you talk to investors and you're like, no, their rents are going up. If they're reading in the headlines, rents are going down without knowing all the data points, their mindset is like, oh, multifamily is not a good place to invest because the rental market is actually getting bad. And you're like, no. Look a little closer. You got to look a little bit closer at the information. So it's like people sometimes look at the news as an objective answer for things, but it's not always objective. And sometimes you have to kind of fill them in on certain points.
That's interesting. The changes in rents, because it can be hyper local. Where we're at right now, in Marquette, Michigan, rents had spiked post COVID, along with a lot of the rest of the country, but they had gone up over the course of 3 years, probably close to 50%. And so we'd seen that coast, they call it the fresh coast because it's on the fresh water, but we had seen coast-like changes in rents. So here in this hyper local environment, rents are doing more like the coast. They've tailed off a good 15% over the past year, where it acts a little different than a lot of the industrial Midwest, where you go further south. Because it's an interesting thing, because there was a lot of people wanting to move up here when they were working remotely, and it seemed really cool. And now that seems to be cooling off a little bit, and kind of back to business, and where are things happening from an industrial standpoint. So from when we're looking at that with the rent, so right now, because I don't do as much multifamily, where do you see rents going up and rents going down when you're talking to investors?
We go to different conferences. We just came back from a conference, as you know, and we see what people are saying, and you hear different speakers are saying. So your question was, where do we see rents going? So I'm right now talking to you from Manhattan. In Manhattan, the rents have kind of lowered down. Has it decreased completely? I think based on what we see in the interest rate market will kind of have a bearing on what we see in the rental market. Things seem a little bit plateaued right now, but it really depends on where you are in Manhattan and where you're at with everything, because there is local changes even within the city of Manhattan. But overall, they're going to plateau at some point, and then they're going to start coming back up again. It's like, depending on what's going on in the overall market, things will start coming back down, and then they'll start to slowly over time go back up. So I really believe that it's going to be tied to how we see things with the interest rate market going. And at the conference, they said that hopefully in the second quarter or the second fourth of this year, there'll be some changes in the interest rate. So it's kind of, let's see.
How much when you're talking to investors, do they come with these types of questions? Do they come in and they're worried about changes in rent and interest rates, or is this more just a headline they saw, so you're the one they ask?
Yeah, both. Both. They will ask questions. A lot of investors who are accredited investors don't have a lot of time to sit there and chit chat on the phone. So really, you get snippets of information. You'll sometimes get an email with a plethora of questions. Sometimes you'll get a little, hey, I don't have time, but I see rents are a problem. I don't know if I want to do this right now. I'm going to wait. And it depends on who we're representing and where they are. Like I said, we were representing a family that was in the Midwest. And in that area, that was in the Missouri area. In the Missouri area, rents were definitely going up. So we had to show them all the news articles that said, yeah, rents might be going down in certain areas, but here in this area, it's actually going up. And here's the reason why it's going up. Industry's moving in over here, here, and here. We placed the property literally right outside of that because that city over there doesn't have enough housing. So therefore, they're moving over here. So we're poised to take advantage of that. And here's some other local factors that play into why this is a good investment. Things that they would not be aware of because they're not local to that area. So a lot of it is explaining, hey, these are the reasons why we did this. And most good syndicators, they do a feasibility study. So you're hiring an outside party to say, does it make sense for us to put a property here? Is there going to be enough economic, change to help us to make sure that this investment goes well? And then you look at the data. So yeah, it's always presenting that.
It's interesting when you said most accredited investors don't have a bunch of time to do the research, and that you just get the email with kind of these shots of questions because as doctors we do that a lot. That you decide to trust somebody, and they're your trusted source now. And I fall down riding my bike and something hurts, and I see one of the orthopods in the doctor's lounge, and I'm like, hey, my shoulder hurts like this. Is this something I need to get checked out? And they're like, no, you'll be fine. You're like, all right, thanks. And it's kind of that same thing. Like, I don't need a full detail thing. I just need the person that I trust to be the expert to tell me this is okay or it isn't. And I could totally see myself flashing off that email like, oh, I saw rents are coming down. What's going on with this?
Yeah.
Just wanting to get that one piece of information.
That's also why it's so important that a syndicator has a long list of investors that have invested with him. Because as long as he's doing a good job, those investors are less likely to scrutinize every single time. They've, like you said, they've trusted him already. So if he has a new deal, there's a little bit of trust already. It's easier to have them reinvest, more funds because they already know, like, and trust the guy.
What's the hardest conversation you've had to have with investors?
I don't really call it hardest. It's really trying to understand them. They basically want to get on the call and understand the deal, whereas I don't even want to present the deal until I understand what are they looking for. Like, what makes them happy? Are they somebody that's looking for high cash on cash? Are they looking for something that gives them more security? So at the end of the day, for me, in my mind, I represent them almost. Because as the investor, I want to make sure that they're happy, because when they're not happy, they're going to come back with all these issues. So I want to make sure I'm putting them in the right product almost, right? So it's like trying to get to the meat of like what makes them tick is like the hardest thing sometimes. Like, no, I don't want to jump into talking to the deal. I want to get to know who you are. I want to know like what makes you sleep at night. I don't want to put you in something that you're not going to sleep at night. That's not good quality for you. It's not good quality for us because you're not going to be a good representation for us. We want to put you in something that you're like very excited about and that you can sleep well at night and not have to worry about. So let me find out those things about you so that I can put you in the right thing. And if it's not right for you, I don't even want to talk to you about it because it's not right for you. So I think sometimes they feel like we're trying to push them into something, but really I want to get to know who they are. So I put them into the right thing.
What are some of the key things, if you're talking to somebody for the first time, that you want to know about them and that maybe they should be prepared to tell somebody about themselves? I think that's, I guess, because I'm asking this, I'm thinking about that a lot of people, when they start looking at real estate, that they're kind of looking at it like the stock market, that is it a good stock? Is it a bad stock? And it's almost like a binary choice. And as you were saying, you want to put them in a deal that works. So what are the the key things that they should be ready to talk to a syndicator about who they are and what they're looking for?
Yeah, like what are their investment objectives? Is your investment objective to get the highest multiple you can later? Is your objective in investing that I want to get, cash flow right now? Like those types of things. What are your investment objectives so then I can know that what is the right thing for you?
Okay. Are there
Tax
any
mitigation. So for some people, it's tax mitigation. Is your objective like you want to mitigate as much tax as possible?
Okay. What are the things you hear that most commonly as their biggest concerns?
They feel that there's risk because it's not an FDIC secured investment, and the definition of what we're doing with private placements and things like that, that there is no security other than we can tell you that this is how this risk has been mitigated, but there is not a guarantee that I can tell you that this is exactly going to perform the way it does. So in that leads a person to say, well, yeah, you could be saying all these things to me, but then it might not happen. And the truth is, a good sponsor or a good syndicator doesn't want to promise something and then not being able to deliver because they're done. They're done basically. Then they cannot do more deals because nobody's going to trust them. So they have to kind of get close to what they think is actually going to happen and kind of say, this is what we think is going to happen. But truth is, we actually think it's going to actually do more than that, but we don't want to say more than that because we want to keep it real. And we have a high probability that it'll get there, but we want to set the bar over here. So we'd rather surprise you with, excess, but then keep it realistic at this number. And if that's okay and that works for you, then this is a good investment for you.
How often do you get a first time investor and they've got some story? Because I hear this that somebody they read about in the newspaper, some little old lady or their uncle that invested in a real estate deal and lost everything, and the whole thing was a scam.
Yeah, unfortunately, it happens. I've been part of those things too. So the thing is, I've been part of it myself years ago. So now I've just learned how to do as much due diligence as possible to protect yourself. At the end of the day, I mean, anything I guess could happen, but there is those stories, and I do have to go through it with some people. That is a possibility. But how many people invested in Enron? How many people invested in some companies that went bankrupt on the stock market? There's nobody that's out there going to protect you 100%. There are things. There's financial advisors that told people, "Hey, invest in Enron," because nobody thought that could happen, right?
Yeah, I guess it's just when I've
Lehman
heard
Brothers.
I've heard from with real estate, people seem more concerned about this, and maybe because it's something that shows up in movies or something. That there was.
Well, it's also in the news right now. It's very popular in the news right now, saying, "Oh, this person took a variable interest rate loan out. They didn't really know what they're doing, and now they can't pay for it." It does happen. It is happening. So the questions are like, how do you mitigate against those risks, and things like that. But it's kind of like saying, how do you mitigate against COVID to certain respects? Because you can mitigate against that problem, but you don't know the next problem that's going to happen. We don't. We just try to do the best we can. But also, to that point, it also makes sense to have a diversified portfolio. So all your eggs are not in one basket.
We'll get back to our show in just a minute, but first I want to offer you an opportunity to accelerate your learning. My life changed, and my ability to start becoming work optional changed when I gained the people and the knowledge to start investing in commercial real estate. One of the key people there was Ash Patel, and joining his Invest Beyond Multifamily Mastermind. Well, that mastermind is no longer open, but for a fraction of the price, Ash has now made a course. And this is probably the most valuable set of information and quickest way to move along your learning curve. So if you are interested in actively investing in commercial real estate and retail and industrial and office, I would recommend this course to you. We're going to include a pre-sale link both in the show notes. It'll also be on the surgeonsyndicate.com website. And in your checkout, it'll save you another 1%. I know it's not a lot, but every little bit helps if you use the discount code Mike1487. If you're not interested in investing actively, give us a call here at Fortress Capital, and let's talk about what your goals are as a passive investor. But it's time to stop listening, start acting, and let's move your future forward.
so you talked about that you had been there. What's the worst deal that you've invested in?
So how many years ago was this? Boy, this goes back maybe 10 years ago. I invested into a syndication that had been performing, for many, many years positively. And then I don't know what happened on the inside, but then later something happened. And then it turned out that they were acting like a Ponzi scheme. There was a lot of investors in it, over 2,000 investors in it. So some things can happen, but it's kind of like those people who invested in Bernie Madoff. They thought that they're getting returns, and the reason I was there for that long is for 9-10 years almost I got positive returns, so there was nothing to question.
Oh wow! So you were invested in that for a long time.
Yeah, there was nothing really to question because by that time, to be honest with you, a lot of my money had turned over. So my original investment had been reinvested in things like that. So I was kind of almost playing with house money by that point. It's tough to tell because it's such a long time period. And then once you get money and then you add more money in and then you get more money out, and then you add some in and then you get more out. So it's kind of hard to tell how much was actually house money and how much was your money. But yeah, that definitely did affect me. Did it stink? Absolutely. What was my lesson learned? My lesson learned from it was make sure I do my due diligence. And even if I do my due diligence, make sure that I have diversified portfolios. I can put it in an asset class like real estate, and I might have other things in real estate too, not just the one thing. In other words, just be diversified and then have uncorrelated diversifications, like some things in real estate and some things in tech or something that has nothing to do with real estate stuff. I guess the big thing is you want to put enough money in that you're testing the waters out, but not putting your whole life savings into one thing.
And into one asset. And maybe that's what happens with the horror stories.
One asset.
People are like, oh, look, they're getting 40% return. So they gather up all their money from everywhere and they put it all in one investment. And then that one investment goes bad.
That's exactly right.
Because if right now, even if you were 100% in real estate, but you had some multifamily sprinkled across the country and some industrial sprinkled across the country and some retail, it's going to be really hard if all of that goes bad at once, the stock market's going to go bad at once and the whole country is going bad at once.
Yeah. So even within, like you said, real estate, you can be diversified. You can have it in self-storage. You could have it in multifamily. You could have it in many different aspects of real estate that, that if one thing goes bad, not necessarily everything is going bad. But tried and true, everybody knows, like even the wealthiest families on earth, they own real estate for a reason.
Well, and that's interesting because this is one that, I've had this discussion recently where people were wondering like why there's differences in returns in the same thing. And a lot of it is the objective. And that kind of goes back to when you said the wealthiest families, it made me think about there's some people who I've got $1 billion. I want my $1 billion to work and I don't want to lose it. I'm not trying to get to versus I've got $500,000 and I want to retire and I can't retire on $500,000. I need to make it a bigger number depending on how you want to retire. So you're going to invest differently than people ask me because we'll do retail like, well, what about Starbucks? I want to invest in a Starbucks. And I'm like, well, Starbucks are a great safe bet. You get a standalone Starbucks with a corporate 15-year lease, and that thing's going to pay 5% for all 15 years.
And if you're on the inside and you've ever seen the leases that they do, it sounds great, but they always Starbucks has these clauses inside their deals that they can leave at any time.
Oh, really? So
yes,
even on that
and that's the thing.
Years.
People want the Starbucks there because they're an anchor tenant, and because they're there, all other good tenants line up. But they're such a corporate juggernaut that they can dictate easily that saying, "Hey, our leases say this. We'll do all this stuff. We'll be here, but at any time, if we decide that we want to be out, we're allowed to leave."
So the standalone, see, that's interesting because I hadn't seen that because the Starbucks.
I have friends that have them. I have friends that have buildings that have the Starbucks in it. They're like, sounds great, but this is the other part that you should know.
So the standalone is really the tough one because if that's all you got is the standalone Starbucks, and that's where I see more of them now. It's a 5 tenant with a Starbucks on the end, but really what you're paying for with Starbucks is that traffic. While everybody's sitting in line at Starbucks looking at your optical shop and your computer repair store and the hair salon and wondering if they want to shop there.
Yeah. Hey, Mike, what's better than having a successful business?
What?
Owning the building that the successful business is renting and paying you.
Nice. Nice.
Their success gives you security.
Well, and that's an interesting thing that is another thing when you get out of the multifamily, when you start talking about a year lease as a short-term lease, that a 3-year lease is a short-term lease, a 5-year lease. It's a nice thing if you own a building and everybody in the building has a successful business, and it's going to take a lot for all of them to go down together. And
Yeah.
if you've got everybody on 5-year plus leases, your stability on that is pretty good. Well, that's awesome. So is there anything else that you would like our listeners to know about here before we start wrapping things up?
Definitely give them my contact information, because what I do is I share the deals that I've already vetted and that I like with my cohorts. And, that's just saying, hey, we've already done our homework on this one. We like this deal for X, Y, and Z reasons. Invest if you'd like to, just let us know. The reason why that has some kind of benefit to it is otherwise you're getting exposed to investment deals on Facebook, right? You're just seeing these deals, but you don't know if anybody's done the homework, if it makes sense. At least this gives you one step, that somebody's done something on this that you may know, and that people have done something on it, as opposed to, hey, I'm just responding to an advertisement.
Where are you looking at deals right now? Or are you agnostic to the whole country, the whole deal, or are there certain areas that you're looking at more so?
No, I'm pretty agnostic to it, but I still like industrial flex, with long-term tenants, triple net properties, that, or absolute properties. It's just a set it and forget it, type of thing. So it's a pretty risk mitigated for me. And then, sometimes I will take a bunch of people, and not make it into a fund. We're just all GPs in it. We're just like an LLC with multiple owners. We're not talking about 10, 15 people. We're talking about just a small group of people, and then we just invest in the property. And the property either has property management or it's triple net, in which case there's nothing to do. The tenant does it. And if it's a lease back, in which case, the actual owner of the building now is saying, hey, I have this business and the building, but I want to sell you the building, and I will sign a long-term lease. I've been here for already 30 years. I'm not going anywhere, but I'll sign a lease for 10, 15 years. So, and I'll take care of the property. I'm just trying to take some, chips off the table. So those leases are really good. They're hard to get, but having access to what I have access to, they come up. So the people that are in my circle, I will offer things to.
Awesome. So we'll include in the show notes, we've got here your LinkedIn, your Instagram. Are those the best places to reach out to you at?
Yeah, or my email too. Please feel free to share my email.
Okay. We'll put your email also in the
Perfect.
show notes. And Amit, thank you so much for being here. To all our guests, thanks for joining us today on Surgeon Syndicate. We appreciate you being here and hope this helped add some value to your life. Join us next time here on Surgeon Syndicate.
Thank you.
We'll get back to our show in just a minute, but first I want to offer you an opportunity to accelerate your learning. My life changed, and my ability to start becoming work optional changed when I gained the people and the knowledge to start investing in commercial real estate. One of the key people there was Ash Patel, and joining his Invest Beyond Multifamily Mastermind. Well, that mastermind is no longer open, but for a fraction of the price, Ash has now made a course. And this is probably the most valuable set of information and quickest way to move along your learning curve. So if you are interested in actively investing in commercial real estate and retail and industrial and office, I would recommend this course to you. We're going to include a pre-sale link both in the show notes. It'll also be on the surgeonsyndicate.com website. And in your checkout, I'll save you another 1%. I know it's not a lot, but every little bit helps. If you use the discount code Mike1487. If you're not interested in investing actively, give us a call here at Fortress Capital, and let's talk about what your goals are as a passive investor. But it's time to stop listening, start acting, and let's move your future forward. This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.